When it comes to the currency world, interest rates are everything. The interest rate set by a central bank is going to have a huge impact on what foreign investors choose to do with a particular currency. Think about it like from a dividend stock in the stock market. If you had option A and B in terms of one stock offers a 2% interest rate or dividend, and the other offers a 3% interest rate or dividend, which one would you choose to invest in? Probably the one with the higher dividend, or the higher, in this case, interest rate. Currencies operate in the same form. If the US central bank has a certain federal funds rate that's higher than other places, investors may choose to sort of move their money towards US bonds and US banks, etc.
FOMC is one of the most important events each month in the trading community. US news events often draw a lot of eyes because of the impact that they can have on the dollar strength, and FOMC is certainly no exception. FOMC, or the Federal Open Market Committee, is a monthly event led by the United States Federal Reserve, an appointed group of officials that govern the United States monetary policy. It's important to keep up with news events because of the massive effect they can have on a currency's strength.
News events are big for markets because they bring in a lot of liquidity. So more news, more liquidity, higher volatility, bigger jumps, bigger price swings over the short and midterm. They are also forward-looking, so they're good at helping with trend prediction and price action in the midterm, and mostly helpful for swing traders, I think.
At this event in particular, the Federal Reserve, led by Chair Jerome Powell, releases their new interest rate decision. The US inflation rate has fallen slightly, currently sitting at 6.5%. Now you might be asking why I just brought up inflation while talking about interest rates. Well, it's because inflation and interest rates go hand in hand.
So as currency traders, when we're trying to evaluate the euro versus the dollar or the pound against the dollar, we're trying to evaluate which one offers a higher interest rate and whether or not that interest rate is worth the risk that we're going to take by buying that currency. Do they have economic turmoil in their economy? Do they have layoffs happening that could cause some concern?
Last month, the Federal Reserve was expected to raise interest rates up to 4.75%, but only raised up to 4.5%. The reason most likely being because inflation is coming down slowly but surely. This month, the Fed is expected to raise just slightly up to 4.75%. Hopefully, we'll continue to see inflation fall with these changes because having to raise rates too much can ultimately be a bad thing.
So why can raising interest rates too much or too fast be bad for a currency? This one kind of gets tricky because, if you're a fundamentalist when it comes to trading or investing, you know that interest rates rising, generally speaking, are pretty good for the currency and can be seen as a pretty negative catalyst for that economy's stock market. When they raise interest rates in the US, the stock market traders, they don't love it because the stock market tends to go down, which is bad unless you're short. Now, when it comes to the interest rate that's offered, why is it bad if you raise it too much? Because again, raising interest rates tends to cause value of a currency to go up, right? Well, if interest rates go up too fast, if they go up too quickly, then what it can do is it can actually put pressure on the economy and actually hurt or even stunt the economy so much that massive cuts to that interest rate might have to happen soon after. And this can cause sort of a rotation back the other way. This is why often if you look at interest rates over time, they tend to rise and fall, sort of with business cycles where economies get red hot and interest rates sort of slowly start to go up, and vice versa when interest rates have to go up when an economy is or have to come down when an economy needs to be stimulated. So it's sort of this ever-changing ebb and flow or balance that the market plays with interest rates to keep the economy running smoothly. Too fast, not so good. Raising rates too fast can be bad. Raising rates or cutting rates too fast can also be bad. There's a slow sort of walk the line sort of effect that comes into play when talking about the Federal Reserve.
Keeping rates and inflation low is crucial now more than ever. Wayne Duggan, an analyst from Forbes, wrote, quote, "In December, the FOMC updated its long-term U.S. economic growth projections, which suggests 2023 could be a difficult year for the U.S. economy. Fed economists project that the U.S. unemployment rate will climb from 3.5% as of December to an average of 4.6% in 2023. They also cut their 2023 U.S. GDP growth forecast to just 0.5% and reduced the 2024 GDP growth projection to 1.6%. With the potential for a recession looming over the economy, Powell and the rest of the board members are taking the necessary actions to prevent that from happening. Of course, some factors that are causing this high inflation are completely out of our control. For example, a global pandemic that would shut down the world for nearly 2 years, and the fact that we're still recovering from it. Or more recently, Russia's invasion of Ukraine causing the price of oil and gas to skyrocket. Trina Paul of CNBC Select spoke with Michael Gapin, the managing director and head of U.S. economic research at Bank of America, about when Americans might finally feel some relief from all of this pressure. Gapin says it won't be until supply chain bottlenecks resolve or overseas conflicts in Ukraine are totally finished that consumers might finally feel some of that weight lifted off their shoulders. We'll see what the FOMC meeting has in store for us coming up very soon.
Tomorrow we have interest rate decisions here in the United States, and we are up in the air on whether or not this number is going to come out as 25 basis point rate hike or 50 basis point rate hike. Now, the consensus right now is mostly leaning towards a 25 basis point rate hike. I wanted to start in an interesting spot, NASDAQ 100, which is an interesting asset if you are sort of looking for something that is going to move heavily to the upside in a risk-on environment. This is sort of your catalyst. Now, or this is sort of your asset to pay attention to, because a catalyst like interest rates tomorrow coming out at 25 basis points has the potential to shoot NASDAQ back up into the previous high. And there could be some excellent trading opportunities to look out for going into this event. Now, I should caution you, if this market comes out with a 50 basis point rate hike, the NASDAQ will likely see a tremendous drop. And we've seen a bit of a pullback as earnings this season have been a little bit lackluster. And by a little, I mean pretty substantially lackluster. And watching this interest rate decision will have a lot of impact on the NASDAQ, but also the Dow Jones, the US 30, the S&P 500. Those assets will also move tremendously. Now, what I'm looking for is predominantly a bullish scenario. If price does end up getting something that the market likes, if the market opportunity to the upside looks promising, I'll be looking for any opportunity I can for pullback buys. Now, you might be asking, why would you be bullish on the NASDAQ? Well, I'll walk you through it here. If I look at the overall watch list for the Edge Finder right now, which is our market scanning software that we use here at A1 Trading, this is our tool we've built, you'll see that NASDAQ actually shows up as a possible buy. And it didn't just pop up here. It's actually been a buy on here for a few weeks now and has offered some great opportunities to the upside. I've been long the indices and made some decent money just trailing stops. Now, the NASDAQ specifically gets a +3. And if we pull up the NASDAQ on the indices category here, we go to NASDAQ 100, you can kind of see where we're at with this. We get an overall score of a buy bias, and some of the main components to this are the uptrend that we're experiencing, inflation numbers on the decline, and unemployment numbers still holding out decently. Now, this number is sort of expected to decline as layoffs are sort of on the horizon for markets, which is also sort of factored in my opinion, in the overall downward trend that we've already seen occur on the NASDAQ for the last several months. Regardless, the momentum here is to the upside for now, and I'm looking for an opportunity to try and hold on to this one on the long side if I can get an entry. Now, back to the actual chart here for a second, you can see the NASDAQ is sitting at the 61.8% and has held this level pretty dang nicely. Now, full transparency, I was looking to get long here and I missed this entry just barely. I was looking to get in 61.8 and missed this trade. If price doubles back, I will still be interested in potentially getting long NAS 100 with a stop loss below the lows. So here is what an entry could potentially look like for me. If we double back between now and the Federal Reserve's interest rate decision, or even perhaps make a move down into this level on the interest rate decision, as long as we get some confirmation, some bullish price action in this area, say for example that we get a pin bar move at this level or something like that, I will look to try and gather a long position in this area, looking for a trend continuation off of the 4-hour chart. So this is something that I am interested in myself, looking for upside continuation, predominantly in the 61.8 to 50% range range in tomorrow's action. So even if the market is volatile tomorrow, I'll be looking to try and pick up an opportunity there on the long side.
Make sure you guys check out the links in the description if you need broker recommendations, access to our free Discord, or want to chat with us on Telegram. If you're interested in our trading software, the Edge Finder, you can find that in the description as well. Thanks for watching.